Okay, so welcome back to the trading desk. What we saw in the first part of the video series was an overall foundation and general understanding of the underpinnings of Forex markets. We built out this foundation which will enable us to understand the Forex market and how it really works from a professional trader perspective. Building that foundation is basically going to help us in terms of our overall knowledge and understanding move on to the next level, which is to actually build out a systematic process that allows us to generate really high quality trade ideas in the currency markets, put those trades on and consistently make money as traders. So we looked at, for example, opportunity set, regimes, infrastructure and computational methods, both everyday basic computational methods that you will always be using in the Forex market, but also advanced computational methods as used by professional traders in order to gauge volatility and really interpret volatility correctly. Now, this overall foundation is something we can always go back to and rely on. This is why we've done it first in the video series, so you get this foundation and you can always go back to it to brush up and always rely on it as a crutch to enable you to keep your head and actually make sure that you're consistently profitable in the markets. Now, just the foundation itself isn't good enough. If you're a typical standard retail trader, you've probably looked at the foundation and you may know some pockets of it, but you probably know only the vast minority of that stuff. From a professional trader's perspective, all of this stuff is really necessary in terms of foundation, but it's not just taken by itself as something that we can only rely on to generate successful trade ideas and profit in the currency markets forever. It's information that gives us the foundation to enable us to do that. So now you can rely on this and make sure you keep going back to that area, the foundation, the first part of the video series. Make sure you keep going back to that in order to keep brushing up and keeping on top of things and what's going on and keep your head. Now we're going to move on to the systematic process, and this is where things get a little bit more interesting. Before we built the foundation, and a lot of it can be quite dry as we're going through it, but it doesn't matter if it's dry, it's just really necessary to understand. This is the type of stuff is going to save you a lot of money and actually make you a lot of money over your lifetime. Now we've got that foundation and knowledge and understanding of how the Forex markets really work from a professional perspective. What we can actually do now is build on that knowledge and build out a systematic process. And the systematic process is really built all on macroeconomic fundamentals. And you saw in the last video where we started looking at time horizons, that the time horizon of 1 to 3 months is exactly how a professional trader, hedge fund manager would approach the Forex markets in order to capture that volatility. Well, to capture that volatility, we have to get fundamental trend. And this is what the systematic process is all about in terms of building out trade ideas that are actually generated by fundamental drivers. So we can actually predict in the future the fundamental trend and then capture that volatility by capturing that trend. So let's go over to the computer screen and start looking at the macro fundamentals. The first thing we're going to do is go through the overall framework so you have an understanding of how it works. Then we're going to go into the next layer, the first layer of the systematic process, which is idea generation and drivers. And the first driver we're going to look at is surveys. So let's go over to the computer screen and I'll see you at the end of the video for a quick recap.
Okay, so welcome back to the computer screen. Welcome to video number 7. we're going to start working now on micro fundamentals. And this is where things get a little bit tasty because we go into a lot of depth and we split everything up in terms of our systematic process into two main areas. The first one is endogenous driver analysis, and the second one is exogenous driver analysis. And what that means is basically we're looking at a country in absolute terms to begin with, so the endogenous driver analysis, and we need to look at something called the static or absolution principle. So what we're actually doing is looking at a country in its entirety in absolute terms, not relative to another country. So when we look at currencies, as you know by now, we can't buy one currency first without selling another. However, we can look at countries in absolute terms by analyzing their economy and parts of their economy that don't necessarily depend on the outside world. That's the endogenous driver analysis. And we also look at the exogenous driver analysis, and that's when we compare two economies to each other and the drivers within those economies that depend on each other. So let's kick off with our micro fundamentals, and we have to do first a little bit of groundwork. For viewers who have already seen the professional trading masterclass video series, so the PTM video series, which is available in the education section of the website, for viewers that have seen this already, you will understand that we use a systematic process across all asset classes. And in the PTM video series, specifically, we started at the top and drilled down. And specifically in the PTM video series, we drilled down through the stock market. So for viewers who haven't seen this already, in the PTM video series, our systematic process was made up of four main key areas. And this is in idea generation, followed by gatekeeping or the gatekeeping process, followed by risk management, followed by self-awareness statistics. And it's no different in the currencies market. So for viewers of the PTM video series, you will be able to apply and understand a similar approach that we took in the PTM video series, and you'll be able to apply that over here in the PFTM video series. And for viewers who haven't seen the PTM video series, this will be new to you, but don't worry about it. We'll explain everything as we go along. Now, in the PTM video series, if we just keep things to basics, the idea generation phase is this phase over here. And what the idea generation phase does, it gives us a worldview to begin with. And our worldview, which is our outlook on the entire world, gives us our commodities views, currencies views, and bond views. And then we went one step further in the PTM video series and went into the stock market and drilled down. Now, what we're doing here is actually combining a top-down macroeconomic analysis with a bottom-up microeconomic analysis. And then we're overlaying this with a gatekeeping process, risk management tools, and self-awareness statistics. And we start off with a top-down macroeconomic analysis because our worldview is driven by macroeconomic drivers. And then we overlay this with a bottom-up analysis because our drivers in the microeconomic analysis are driven by our micro drivers on industries and stocks. When we come over to the currencies situation, we don't need to worry about microeconomic analysis. All we need to worry about is our worldview, so our top-down analysis. And for viewers who have never seen this before, we just need to ensure that you understand here that there's 4 main key areas, and that our worldview and therefore our currency views are driven by macroeconomic variables. Now, when we go into currency views overall, you'll see that the currency views are driving our worldview as well. So our worldview we can obtain in its entirety over here, and this can drive currency views, but currency views can also drive our worldview. And when we take a snapshot or go inside currencies, so what we're doing is looking at the currency view idea generation area. If we magnify into that, what we'll find is that our currency views occur because of a number of drivers. And we have drivers on the left-hand side here, which are leading indicators. We have coincident drivers, which are also indicators. And we also have drivers here, which is our injections and withdrawals. And over coming in from the left-hand side, our leading indicators drive our coincident indicators and injections and withdrawals because they react. Now, if we go into the right-hand side first, this will be easier to understand if we come in from this side, because we've seen a lot of this already when we went through our foundation earlier in the video series. We can see here that injections and withdrawals are a combination of central bank and government actions, therefore monetary and fiscal actions. And we've listed the main drivers of monetary, so central bank behaviors, and government, so fiscal behaviors. And these are typically reactionary to what we have on the left-hand side. And what we have on the left-hand side are leading indicators, which are drivers that lead the economy. So they predict what is going to happen in the economy. And we have coincident drivers, and coincident drivers follow leading indicators, and central banks and governments react to both. So this here, this entire area, is basically how we obtain trade ideas in currencies. So this is the major part of our entire systematic process. We're going to be going into great detail of how we actually generate ideas by looking at all of these drivers here. Then we overlay this whole process with the gatekeeping process. And the gatekeeping process is done for several reasons, which will be explained much later on in the video series once we've been through all of these drivers. But essentially, we have here 3 situations that we use in order to time our ideas. So the whole purpose of this systematic process is to bring you up to a more professional standard, because systematic processes like these are applied by hedge fund managers. And if you walk into any hedge fund and you're an investor in the hedge fund, you'll obviously be wanting to know what their process is for selecting their positions. And this is a typical systematic process that you would see at any major hedge fund in the world. In fact, if you actually go to them and as an investor ask them after you sign a non-disclosure agreement, you actually ask them as an investor to see the detail of their systematic process, they will actually give that to you if you're a pre-qualified serious investor. And you will see that when you look at their systematic process will actually be just a derivative example of exactly what you're learning here. And we have our idea generation up here and our gatekeeping here. Now, what we're trying to do here is become more like the hedge fund who use the systematic processes. And we've seen all the reasons why in previous video series, because they take a much more fundamentally driven approach. And all of these things here are fundamental drivers. So we get fundamental trade ideas. Then we have our gatekeeping process, which is all to do with timing. So we use indicators to time our trades. So once we have an idea, the idea is just an idea. It's not yet a trade. So what we're trying to do is actually turn it into a trade. And we're hoping or wanting the timing to line up with our fundamental trade idea. This will all become a lot more apparent as we go through the video series. Then we have our discipline area. So this is using risk management processes. And we went through earlier in the advanced computational methods with Chris Quill, a distributions and ATR analysis of the Aussie dollar and the euro dollar. And from this advanced computational method of distributions and of ATR, what we discovered was that we have an input of volatility analysis that we can use in assessing within our systematic process. We can use this to assess both opportunities and risk. And these things all feed off each other, because you're not obviously going to seek trade ideas out in extremely non-volatile situations. So we're going to be sticking to our tradable set. And then also within risk management, we have a bunch of risk management metrics that we apply to any sensible portfolio, any sensible long, short portfolio that has a time horizon of 1 to 3 months, because we have the evidence that the volatility that we're looking for is over a 1 to 3 month time horizon. This is when we actually have a portfolio. And here we have our self-awareness statistics that we're going to be looking at later in the video series. But now let's focus on the idea generation. And if we zoom in to our idea generation area, as mentioned previously, we have 3 main areas, and we have to try and really understand these areas and how they feed off each other. So on the left-hand side, we have what we call leading indicators. So these are drivers that lead the overall economy. And then we have coincident drivers. These tell us what is basically going on in the economy right now. And we have injections and withdrawals made by central banks and governments using, respectively, monetary and fiscal levers. And the way this works is pretty straightforward, and maybe a quick example might actually help you to fully understand how this actually works. So if we look at the left-hand side here, let's assume that we have an indicator that can tell us that in 12 months from now, the economy will grow at a 3% GDP rate, GDP growth rate, there will be 6% unemployment and inflation will be 3%. Well, what happens is that 12 months later, it's very likely that if there's a large correlation between our driver over here and what it actually predicts in the past, there's a very high probability that that's going to be the case, there or thereabouts. And central banks and governments react essentially to what is over here on the left-hand side because they are concerned about what's in the middle here. So if we just read through what's on the bottom of the screen here to understand this, central banks and governments are committed to affecting the coincident drivers. So this section in the middle here. And they do that through injections and withdrawals. Now, leading drivers predict what central banks and governments will do. Because they predict what coincident drivers will do, they also predict what the reaction is going to be. And the coincident drivers themselves lag the policy commitment from the central banks and the governments. So the leading indicator predicts what the coincident drivers are, therefore predicting what the reaction is going to be. And the coincident drivers lag both of them. So take a little time for that to sink in, because it's quite important to get the flow and understand how the economy actually flows. So this is basically information that is given to policymakers on a regular basis, and it's also publicly available. Given to policymakers, and because of the predictions of the drivers, the leading indicators, injections and withdrawals are made. Central banks and governments react because they are politically and economically committed to ensuring a certain level of inflation, ensuring that there is a high level of employment in the economy, ensuring that there is a good balance of trade in the economy, and overall a good and constant level of real gross domestic product growth. Okay, so we understand how this flow occurs, and we must always keep this in the back of our minds. We must understand what the leading indicators are in terms of drivers and how they predict. We must understand that these drivers here are reactionary, and we must understand that these are coincident indicators that don't tell us what's going to occur in the future, but give us a very good snapshot of what's happening right now and what these guys could possibly be doing in reaction to leading indicators that predict in the future what's going to happen here. So we keep this flow in the background and we understand the flow of the drivers. And what we do is first, we basically break down all of these drivers further into both endogenous and exogenous drivers. So what is this? Well, the endogenous driver analysis, and this is where we're going to start. The endogenous driver analysis is predicated on a static or absolution principle. So the word endogenous basically originates from the Greek word endo, which means coming from inside the system. And the word exogenous originates from the Greek word exo, meaning outside. So to produce. So referring to an act, an action or object coming from outside the system. And the value of a currency can essentially be affected by both internal and external factors. So both endogenous and exogenous factors. So what we do is we split up our driver analysis in order to generate fundamental trade ideas, so whether we go long or short a currency, in absolute terms. So in absolute terms, that is in endogenous. So in an endogenous sense, with an endogenous approach, and in relative terms. So we look at a country and we decide whether we go long or short a currency based on external drivers. And we basically combine the two analyses. And what this does is it provides us with a systematic approach, a macroeconomic systematic approach to generating trade ideas. And this can be applied to any country or currency, so we can basically compare them to each other. And we've mentioned this a few times so far, but a currency basically cannot be bought without first selling another currency. So basically, backing a currency itself versus another is exactly the same as backing a country's economy versus another. So what we have to do is utilize this systematic approach to create a fundamental watch list of currencies that we want to be long and currencies that we want to be short. And then we basically match them off against each other in order to optimize our trade ideas. And then we overlay this process with timing, so the gatekeeping process, risk management, and self-awareness statistics. Now, what we're going to be doing is we'll be using the United States and Australia as examples to do this. And what you've got to do is then practice by adding all the other covered examples, so all the other tradable set that we've gone through already in Foundation. And one of the things we do at the Institute, and not just at the Institute, but in all professional trading circles, so at investment banks and hedge funds, is we stick to something that we call the self-reliance principle, or the self-starter mentality, self-starter principle. And we use this throughout all of the Institute education, and it also applies here. So what we're not going to be doing is literally going through every single currency pair with you and every single country and showing you the analysis on every single country and currency. That would be pointless, because what we'll be doing in terms of teaching you that way is actually we'll be spoon feeding you all of the information and resources, and you won't actually learn anything for yourself. So what we're going to be doing is creating the systematic process within the United States and Australia, and then you have to then take this process and apply it to all other countries and currency pairs. So in terms of the US and Australia, it will be a very, very detailed example of how to go through the full process. So going through the United States initially, and also going through Australia. But going through this process is very, very detailed. And then what you've got to do is then apply this to other countries and currencies within the tradable set. What you'll actually be doing by doing this is you'll be learning by doing. So learning with immersion and learning the skills required from the ground up, so you don't need to rely on others for the information ever again. And it should be pretty obvious by now why we're going to do it this way. Because if you did walk into a hedge fund or an investment bank and you somehow managed to convince them to give you a job on the desk, it's pretty obvious that they're not going to hire people who walk onto the trading desk that they don't believe could actually become the self-starter and become the decision maker of where to put capital at any one time. What would be the point of hiring somebody for your hedge fund or investment bank prop trading desk if when they sat down their sole function was to just do what you say. It's obviously not going to be the case. The people who get hired on trading desks at hedge funds and investment bank prop desks will be put through this process for at least a year, and dependent on how quickly they pick things up, is dependent on when they actually get capital and when they're actually trusted to make investment and trading decisions, because the managers are aware that they can now be self-reliant and be left to their own devices and make proper investment decisions, because they understand everything behind the process. They understand the numbers. So now, with the endogenous driver analysis and overall in macroeconomics, what you need to do is start thinking of everything, literally everything, in terms of injections and withdrawals into and out of the economy. So what do we mean by this? Well, let's have a recap. All things being equal, injections are inflationary and are intended to cause growth. Withdrawals are deflationary and intended to slow down or cool down the economy. But there is a caveat to this, and a caveat to this whole process. The perfect country literally does not exist. So if you're looking for the perfect situation to go long or short, just let me tell you now, it never exists, because the perfect country doesn't exist. What is the perfect country? Well, the perfect country in economics really is a country with high GDP growth, low inflation, 0% unemployment, and has a huge balance of payments surplus. Obviously, that situation cannot exist. And you'll see why as we go through the video series. There's always going to be something wrong with a country. So please remember that. And what we're going to do when we go through both our endogenous and driver analysis, we're going to look at each driver, whether that's a leading, coincident, or reactionary central bank government driver. We're going to be looking at each driver, and we're going to be assigning a score to that driver. And that score is going to be dependent on whether the driver gives us an inflationary or deflationary signal. And the scale we use is going to be from -10 to +10. And +10 is going to be the most inflationary, and -10 is going to be the most deflationary. And what we're looking for is fundamental highs and lows. Now, the best way, and probably the only way, to understand how this systematic process and scorecard works is to actually just get our hands dirty and do this. Once you get into it, you're going to start understanding how the scorecard system actually works. So let's start with our first driver within our endogenous analysis. Let's start with surveys. And surveys, which are available globally, are basically leading indicators. They're indicators that lead the economy. And in each economic region, the only two participants of the private sector are businesses and consumers. So what really matters is the private sector, and it's made up of businesses and consumers. And what we do is we look at business and consumer sentiment in countries and economic regions across the world in order to gauge the likelihood of inflationary or deflationary conditions in the future. And by doing that, because these indicators are leading drivers, by doing that, we're actually predicting the future of what central banks and governments are going to do because they are concerned about the classic coincident drivers. So if you remember back to our idea generation flow analysis, we had leading indicators as drivers on the left-hand side predicting both coincident indicators and what central banks and governments are going to do, because central banks and governments are primarily concerned with the coincident drivers. And surveys are an endogenous driver because we're looking at the country or the economic region in absolute terms. So let's build into our major example here. And with surveys, the main question that we need answered all the time is if businesses and consumers are bullish or bearish on the future health of the domestic economy. So if businesses are bullish, they're obviously going to invest more in growth, and this is inflationary. And if consumers are bullish, they're going to spend more now because they are more confident of their future economic prospects, and that's inflationary. And if the opposite occurs, then obviously we have deflationary predictions. And what we're going to do here, and we're going to stick to our self-starter, self-reliance, non-spoon feeding principle, but we're going to cut you a little bit of slack. We're going to start with the United States. The United States is going to be our big example of the endogenous analysis. Now, obviously, this systematic process can be applied to any country in the world as long as you can get the data. But we're going to do it with the United States because it has the most data available and it's the world's reserve currency. So you actually have to know this stuff. And this is why we've included the United States as the major example of applying the endogenous analysis principle and the systematic process, because you have to learn what goes on in the United States because it's the world's largest economy. And having a view on the United States and the US dollar, so the world's largest economy and the world's reserve currency, having a view on them in absolute terms is absolutely crucial to all currency positions. So we have to find a balance here in the video series, which is to stick to this self-starting, self-reliance, no spoon-feeding principle. But at the same time, we do have to cut you a little bit of slack because we have to show you how the systematic process works. And the best way to do that is to show you with the United States, because it's the world's largest economy, it's the world's reserve currency with the US dollar, and the data is freely available. What that does for you is provide you with a template, which then allows you to apply the endogenous analysis as part of the systematic process to all other countries in the world. Okay, so let's start with the United States and start looking at surveys. And the first survey we're going to look at is the Institute for Supply Management, ISM, Manufacturing Index, or the Purchasing Managers Index. Viewers of the PTM video series will be well aware of this one. It's one of the most important leading indicators in the world, and it's released on the first business day of each month. And the release can be found here at the URL that's available. And basically the way this works is the members of the Institute for Supply Management and the Business Survey Committee, they receive a questionnaire each month that asks them to identify month-over-month changes for each index within the overall composite index. So the sub-indices make up the overall composite index. And basically the members are the largest 300 US manufacturing companies in the United States. And these questions relate to their business activity in the previous month. And they cover 5 areas with an equal weighting, and those 5 sub-indices make up the composite index. And it's really significant because it represents 20% of the US economy. So it has a 20% business contribution to gross domestic product in the United States. And it's the manufacturing sector. It's physical goods, real goods, bought and sold in the United States economy. Also, the reason why it's so important is because the data is really robust. It goes back as far as 1947, and because the data goes so far back, we can actually use it to correlate against other indicators in the economy and get a very good data set going back many, many years over many, many business cycles. And there is another driver that we're going to look at, which is the non-manufacturing index a little bit later. But the data in the non-manufacturing index only goes back to 2008. The non-manufacturing index represents the service economy within businesses. And because there's more historical data, we can fit the data over many, many years and many business cycles, and there's a higher confidence level in the correlations that we obtain between indicators. And the historical correlation between real GDP growth in the United States and the ISM manufacturing data going back to 1947 is around 85%. So it's extremely high and extremely good at predicting the future of the economy and also predicting what central banks and governments will do. And we can have a look at what the correlation between the ISM manufacturing index and real GDP growth actually looks like pictorially. And this is what it looks like. So what we've got here is a chart which shows the ISM data going back to the year 2000 and leading right up to the present day. And you can see the ISM data with the white line and the area under and above the white line is filled in to give you a sense of the magnitude of these moves. And the columns is real GDP growth on a quarterly basis. So a quarterly annualized number. And you can see the direction for the vast majority of situations, for the vast majority of quarters, the direction of the ISM really does predict, in the vast majority of cases, the direction and level of GDP growth. And what we can do is go into our spreadsheet, and our spreadsheet has a full breakdown with all the data. Now let's go through the basics of this spreadsheet first. You will see a lot of sheets at the bottom here as part of this overall spreadsheet file. So we have basically multiple spreadsheets within one spreadsheet file. This is to make your life easier. So all of the data is in one place, and all of the processes that we go through in using Excel, you need to try and learn all of these and make your life a lot easier. So we're working smart, not hard. All the data needs to be in one place. And right now we're on the ISM tab. And if we just run through the sheet from the left-hand side, the first tab we have here, the first spreadsheet, is the US endogenous score. We're going to be looking at that right at the end of the endogenous analysis. Here we have our sources. Our sources are basically where we're getting the information from. We also have cycles. So these are the recessionary periods in the United States since World War II. We have our GDP percent tab. This GDP percent tab is real GDP reported on a quarterly basis at an annualized rate. And we have all of our drivers that we looked at earlier all the way across our sheet. And if we start with ISM, you can see that we have 3 columns. We have our date, our ISM number, and the percentage change. Now, where do we get this data from? Well, let's go into our sources. If you look in the sources tab in the spreadsheet endogenous analysis, which is available in the download section, you'll see the link here. And all you have to do is take this link, put it into your browser, and it comes up here. And you can navigate for the download of the PMI data. And we can see here that the last PMI was 51.5. So we've got the data here. Once you download the data, all you have to do is stick it in the sheet and work out the percentage change. Sorry, the nominal change. And the nominal change is the amount of points that the ISM has changed on a month-to-month basis, going back all the way to 1948. And if we scroll all the way down, we can see that it goes up to February 2015. And all we have to do is chart this. And you've seen earlier in the Excel training with Chris Quill how you do this. You select the cell, you go to Insert, and you form a 2D column. A 2D column chart. We click on Select Data. We edit the X-axis, and we choose the date. And we do Control-Shift down. We hit OK. And then we scroll back up. And our chart is now ready. Our chart is now ready to be changed into a line chart. And all we have to do to change the chart type is go to this area here after clicking on the data within the chart. Click on Change Chart Type, and you can see at the moment it's defaulting to column. We change that to a line and we hit OK. Now all the information is there going back to 1948. You can play with the design. You can turn the background into black. You can turn the data and the text on the axes into white font. You can change the style of the font. You can change the minimum and maximum on the ranges. You can do everything. It's all very straightforward. But the basic principle is to get all of this on a chart so you can see this pictorially. And here's one we made earlier, which is the manufacturing index going back to 1970. And this is actually till 2015 now. And if you want to reference or zoom in on the dates, all you have to do is go to Format the Axis and you change the dates here. So you can quite easily change this to the 1st of January 1970 and it changes the chart. What you can also do is add in GDP. And if you click on GDP here, and we look at the data series of GDP, you can see that the cells that we're referencing are in a sheet called GDP. And right at the end of our data series, right across the tab, across here, we have our GDP annualized percentages. So we have them for ease, we have them at the beginning and at the end of the sheets, so it can save you scrolling across a lot of the time. And you can see the data going all the way back to 1948. And this takes us all the way up to February 2015. And the last real GDP growth number that was reported on a quarterly basis at an annualized rate came in January, and that was for the quarter October, November, December 2014. So if we just OK that, because we're just showing you where the data's come from, this is how we got the chart earlier that we looked at in the presentation. So we need to look at the ISM Manufacturing Index because it predicts what GDP is going to do. Now, if you want a much more thorough, in-depth analysis of the ISM, viewers of the PTM video series will understand that we go into a lot more depth of the ISM in the PTM video series than here. So if you want a more in-depth one, then you can do the PTM video series, obviously. Now, if we go back to the presentation, this is how the ISM is actually made up. It's made up of 5 key areas, and it's made up of new orders, production, employment, deliveries, and inventories. And they all get a 20% weighting, 5 areas, and when you add up all of these areas, you get the composite index, which is more commonly referred to as the composite PMI or Purchasing Managers Index. And what we really care about in currencies, as we've seen from the overall systematic process, what we really care about is our overall view on currencies themselves. We don't really care about the inside detail of everything inside the ISM. What we care about is the composite number. We care about the direction of the ISM, and we care about the magnitude of the moves on a month-to-month basis of the composite number. Now, in the PTM video series, we do go into a lot of depth into looking at sectors within the economy. So sectors that are growing and contracting. So growing and contracting, or so either contributing positively, so growing, or contributing negatively to the overall growth or contraction of the economy. With currencies, the aggregate or worldview is more important. So the United States, as the world's largest economy, growing or slowing in aggregate. Is the world growing? Is the world contracting? That's all we really care about at the worldview level. So what we do is we scorecard the PMI in the following ways. Now, when the ISM is above 50, this is an indication that the overall economy is growing. So we're forecasting that there's going to be positive GDP growth in the next 12 to 18 months. If the ISM is below 50, it means the overall economy is set to contract, and that will give us negative real GDP growth and even possible recession. And a recession is defined as 2 negative quarters of real annualized GDP growth in a row. So we scorecard for our currencies in the following way. So if the ISM is above 50 and growing, we will give a fairly high inflationary score, which is a +5 to a +8 on the scorecard. And an inflationary score gives us a short bias, or tends to give us a short bias on the currency. If the ISM is above 50 and slowing, we're looking at a 0 to +5 score. So what do we mean by that? The ISM is above 50 and slowing. Well, let's say last month the ISM was 59, but this month it's 55. Well, that means it's still above 50, so it's growing, and it's forecasting that the economy will grow. But what it's saying is that it's forecast to grow at a slower rate. So the ISM above 50 and slowing, we give a lower score because it's less inflationary. So we have a score of 0 to +5 on our scorecard. However, it's still inflationary, so we do have a short bias towards the currency. Now, what if the ISM is below 50 and slowing? So the economy is set to slow down faster than last month. Well, we give this a minus score of -5 to -8. And this is predicting deflationary conditions in the future. So we're predicting that in 12 to 18 months' time, the economy is going to have negative real GDP growth. And that means we're looking to have a long bias on the currency because deflationary conditions cause a currency to have the opposite situation in terms of inflationary conditions. So let's think about this for a second. If we have inflationary conditions, it means the purchasing power of paper money, as we've seen in the past, the purchasing power of paper money decreases because inflation is increasing at a rapid rate. So the purchasing power of money goes down. And if we have the opposite situation, we have deflation, it means that the purchasing power of paper money is actually getting stronger. It's going up. So we want to be long this currency. We want to own the paper. And in the opposite, with inflation, we want to get rid of the paper. We want to be short the currency. So that's a basic principle that we have to get used to. And as we go through the scorecards, this is something you'll always have to remember, because when we go through each driver and each scorecard, we do score everything based on inflation and deflation and decide whether we're going to have a short or a long bias. And whether it's inflationary or deflationary, we get predispositions or biases automatically from these scores. Now let's move on to some other situations in the ISM. So the ISM below 50 and growing. Now that means that it's reported below 50, but it's not as bad as last month. So let's say, for example, the ISM is 49 this month, but the month before it was 45. Well, we still score this as a negative, so 0 to -5, but we have a long bias and it's obviously still deflationary, but things are potentially getting better. They're not as bad as before. So like I said before, just doing this and understanding it and going through it gives you an idea of how we're scoring on our scorecards. And we're just really learning through immersion. So we'll just continue to keep going, and you should pick things up as we go along. The next thing we look at is the ISM peaking. So the ISM peaks above 50 and slows for the first time in the current cycle. Now, what do we mean by that? So imagine a situation where the ISM 3-4 years ago was below 50 and then it went above 50. And then it continued on its path, getting better every single month. So month on month, it might go from 51 to 51.5, 52, 52.5, 53, 54, and it might go up to the low 60s. And it might take 2 years to get there, 3 years to get there. Now, if the ISM peaks above 50, it means that it's got to the highest point and then it's gone lower. And going lower for the first time. And with this situation, it basically means, if we look historically, that the economy could have got to a peak in terms of business sentiment and GDP growth. And we're talking about predicted GDP growth here. So we're now looking at the ISM and saying business sentiment predicts that we have peaked in real GDP growth, and in 12 to 18 months' time, real GDP growth will likely be lower than what we've already seen or what we've already predicted. And in this instance, we actually have the opposite to what you would expect. So we're actually at this stage predicting deflation because we've been through a very long inflationary period, and it means that we may have got to a level where we're now starting to cool down in the economy. And this can happen naturally, or it can happen reactionary. So it can happen because central banks and governments are reacting to it. So the principle to get here is that when the ISM peaks, things basically can't get any better. We can't grow faster than this rate. And if we can't grow faster, then the only way is down. The only way is deflation. And that's when we're basically entering a situation where we first start predicting deflation. So the ISM peaks above 50, slows for the first time, and we start predicting that there's going to be deflation in the future. In this instance, when we predict deflation, we always automatically have a long bias predisposition to the currency. Now, what about the opposite situation? So the ISM, let's say, is well below 50, but it's now turned around. It's troughed for the first time. So we have peaks above 50 and we have troughs below 50. So this could be the end of an extremely contractionary GDP period. And the ISM is predicting that in 12 to 18 months' time, that the economy may have bottomed in terms of its contraction. So now we're growing for the first time. We're predicting that in the future, the slowdown is either going to be less or we may even grow in the future. And for this, we actually have a short bias because now we're starting to see inflation coming into the economy and we start to score positively. And for this, we score a +8 to a +10. In the opposite situation, when we have a peak and we're predicting inflation with a long bias, our score is to have a -8 to a -10. So again, we're going through this and getting our hands dirty and really getting into it. So hopefully you're picking this up as we go along. But what we can do now is go over to the spreadsheet and just have a look at some of these cases. Okay, so let's go over to the endogenous analysis spreadsheet and start looking at how this really works with the ISM. So if we open up the spreadsheet, make sure we're in the ISM here, and we're looking specifically at this chart here. We're looking at the ISM going back to 2000, and the ISM value is on the left-hand side. We're going from 2000 up to present day. And we have on the right-hand side real GDP growth on a quarterly annualized basis. So let's have a look at the extremities of the ISM, so peaks and troughs. And you'll see here, let's start in the last business cycle, where we can see the ISM from 2003 onwards really growing aggressively. What was happening then? This was post September the 11th, 2001. The economy was in bad shape and the Fed was cutting rates aggressively and continued to cut rates, and business sentiment started to rise and there was a lot of inflation in the economy. And then we got to a peak here around 2004, and that's when the rate cycle turned and we started seeing rates going up in terms of managing the overall growth of the economy. We then saw business sentiment rise and then drop again going into the financial crisis of 2008. And you can see the next thing that happens, we drop into the financial crisis of 2008, where business sentiment goes very negative, and then we have a turnaround, and we have a positive ISM all the way up till 2012, where we get a few negative readings, and in 2013 we have a few negative readings as well. And when you look at all of this taken together, what we're doing is just looking at the last 2 business cycles, and we're comparing the ISM to GDP, and what we're trying to understand here is how the ISM can be read to predict what's going to occur in the economy. So it's pretty obvious that when the ISM readings come out and they're very low, then this is a warning sign that GDP growth is going to slow down in 12 to 18 months time with an 85% certainty, because the data tells us that the ISM is correct 85% of the time in predicting GDP growth with a 12 to 18 month time lag. And we can see here, let's see if we start at the peak of the last business cycle, we see in 2004 the ISM peaks, and we end up basically having a slowdown in GDP growth. And you can see this in the numbers. You can see this coming through later, where we have a fall from around 3.5% GDP growth to 4%, falling down to 2 to 3%. And then we go even lower to 1% and 0.4% when we look 12 to 18 months in advance. And this is a deflationary situation. And then we also have, when we go into the financial crisis, we have a peak up to 2006, and then this repeats itself. We end up having a collapse of the ISM, and then as the ISM is collapsing 12 to 18 months ahead, we see negative readings of GDP numbers coming through. We then have a trough. 12 to 18 months later, surprise, surprise, we have positive GDP growth because we've gone through the 50 level. And then in the period later, GDP growth is reported to be positive. And we come to have negative readings here, and we get quarterly annualized rates 12 to 18 months later, a quarterly annualized rate that's negative. But what's actually happening here is the whole time the ISM is also affecting the actions of the central bank, the Federal Reserve. So the 4 things to remember with the ISM, the 4 things to really understand are the principles of growing and contracting. So 50 and above predicts growth. 50 and below predicts contraction. But also we have peaks and troughs. So the peaks in the ISM are when inflation essentially is extremely high and potentially out of control. And then we can enter deflationary conditions. Or we have the troughs where basically deflation has become so bad that it's a real threat to the economy, and central banks are reacting to spur inflation. And then we have the trough where we get the turnaround. They're the 4 main things that we need to look at. Also, we need to look at the situations in between. So the situations in between are the major slowdowns, so the big slow trend. And also, we need to look at the major inflationary trends. So the major inflationary trend here, for example, in 2009 and in 2010. And you can understand that the things that were going on in the current business cycle back in 2010, 2011, 2012, all of these things were culminating into monetary policy responses from the central bank, which were attempting to create inflationary conditions. Now, if we go back to the presentation, it means we can start to understand this slide a little bit better, whereby if we look at the 6 cases, we have the ISM above 50 and growing. We tend to have a short bias, but the scorecard is not extreme. So we're looking at medium to high conviction on our scorecard. So we're scoring a +5 to a +8 on the inflationary scale of 0 to +10. When the ISM is above 50 and slowing, that is actually an inflationary bias, a short bias to the currency, but with very low conviction. The ISM below 50 and slowing is -5 to -8, so a medium-sized conviction on deflation. And the ISM below 50 and growing is still deflationary, but we have a lower conviction long bias. Now, when we enter the peaks and the troughs, these are extreme situations. So when the ISM peaks above 50 and is slowing for the first time, or may have peaked, we have to be very cautious because there could be deflation around the corner. And for this, we actually score an extreme long bias, because if we've peaked, then deflation could be a real surprise to the world. Now, if the ISM troughs below 50 and is growing for the first time, so we're potentially getting less contractionary, this is also an extreme scenario. And in this scenario, history tells us that predicting inflation is the right thing to look at, because inflation is likely to come around the corner. So we look at the extreme situation and we start predicting that inflation is going to come back into the economy, and then we have a short bias towards the currency. So we have a scorecard of +8 to +10. So like I said earlier, we're going into this, we're getting our hands dirty, and we're looking at the data straight away to try and really understand how this works. And we're doing this in practice, so learning through immersion. Now, if you want to look further into the ISM Manufacturing Index, you can obviously go online. It's all publicly available information. You can download the data yourself. We've given you the link there to the ISM. You can play around with the data. You can look at the makeup of the ISM. And if you want to really apply it to stock markets as well, you can go into the sectors, and we teach you this in the PTM video series. And everything's linked, really, because your worldview on currencies being dictated by currencies is also dictated by the stock market itself. And all of these things are linked, so it's always a good thing to do to further your education. But right here, right now, we just assume that we don't need to go into the nitty-gritty detail of the ISM. What we need to understand is just the headline number. And we need the plain vanilla situation of whether we're growing, whether we're set to contract in the future in terms of GDP growth. We need to know whether we are at a peak or a trough, or we've come from a peak or a trough. And we need to know the rate at which we're growing or contracting. And the ISM, the report on business, the PMI, it's overall one of the most important leading indicators in the world for professional traders. And it's because historically the ISM has predicted US GDP with a 12-month time lag with 85% accuracy since data began. And the great thing about the ISM is that because of the accuracy in predicting US GDP, it also has a very good indication of whether global GDP is set to grow or contract, because the United States is the world's largest economy. So what we do is we use the ISM as a guide to the overall medium to long term absolute fundamental currency direction for the US dollar. And this is important. It's important not to forget that we're looking at everything here in an endogenous format. So we're looking at the ISM and saying, well, if it's growing, that's good for the US economy. If it's contracting, that's potentially bad for the US economy. If it's growing, then slowing, that's good, but not as good as previously thought. If it's contracting, but contraction is less than the previous period, that's still bad, but things are getting better. And what we're understanding here is the United States economy from an endogenous perspective. This is not affected by forces outside the United States. But what it also does is the ISM also tells us what to expect from policymakers in Washington and at the Fed. So at the government level and at the Fed. So the ISM is basically one of the main predictors to predict the coincidence indicators and how the Fed and government will react with policy. So it's very, very important to our analysis. It's a great start in our overall endogenous analysis, because once you get the principles behind understanding how we scorecard the ISM and what the ISM is all about in terms of predicting inflation and deflation, once you understand that, this analysis, you can understand how we start to build out looking at other drivers and how those other drivers are analyzed in order to work out what's happening in the United States and therefore what our view is on the US dollar. Now, something else that is pretty crucial to understanding what we're actually doing here in terms of the endogenous analysis, the static absolution principle, as in we're just looking at the United States in absolute terms, needs to be applied here, and you need to be reminded that this is what we're trying to do. Because if you think you're going to put, for example, the currency data of euro-dollar onto the ISM chart and try to correlate that with ISM and GDP growth, there's a lot of problems you're going to have doing that, because the currency pair depends not only on what's going on in the United States, but what's going on with Europe. And it's a relative situation that you're looking at when you look at a currency, because again, you're looking at buying one currency and having to sell another in order to purchase it. And the value of a currency pair depends on the relative situation in terms of economics between the two countries. And this is exactly why we split up the analysis in our systematic framework as professional traders into endogenous and exogenous analyses. And then we combine the two, because what we want to do first is get a total understanding of what's going on within the United States and all the drivers for the US economy that are not affected or do not affect what's going on outside the United States. We get a snapshot of the United States in absolute static terms. And that's really important to understand, because it's a fallacy to go out there and look at euro-dollar as an example and try to predict the US economy based on the value of the euro-dollar. You're going to get into all sorts of problems doing that, because it's a relative situation. If Europe is great and the US is great, when we add that together, what does that mean for the US economy? What does that mean for whether we should be having a long or a short bias in euro-dollar? What does that mean for the European economy? Well, it's a very muddled approach. What we have to do first is look at the United States, figure out what is really happening with this economy, scorecard it very objectively without having any outside influences, and then combine this with an exogenous analysis. And the exogenous analysis is where we compare it to another country. So let's start continuing to go through with the endogenous analysis, and this whole situation will build out for you, I promise. It's a lot of information to go through, but we have to try to, as retail traders, we have to try to get up the curve and become much more professional in our approach and take the same approach as professional traders and hedge fund managers. We need to get up that curve and build the systematic process out. So just try to understand these principles that we're going through. The absolution principle is a little bit tricky to understand, but again, we're just going to continue to go through this, force our way through the video series, force ourselves to understand the basic principles, and hopefully these principles will stick and the systematic process will stick with you, and you'll start to really understand the dynamics of this. Okay, so that just about covers the ISM Manufacturing Report on Business or Purchasing Managers Index. In terms of our drivers, let's have a look at our next driver. So now we're going to look at the ISM Non-Manufacturing Index, or the NMI, which is also known as the Services PMI. So we're not looking at the manufacturing sector now in the US, we're now looking at the services sector. And all you have to do is go into the endogenous analysis sheet here, and you can see we have our ISM analysis there. And we'll just delete that. What we're doing is we're going into our NMI sheet at the bottom here, the non-manufacturing sheet, and we do pretty much exactly the same analysis with the non-manufacturing index as we did with the ISM manufacturing index. Now, if you recall, we have our sources over here, and our business sentiment for the non-manufacturing index, the NMI, is exactly the same source, the ISM website. And we go here, we find our NMI page, and we just follow the links to look for the download. So in your own time, have a look through the website, get hold of the data, and you download into the NMI tab. Also, just quickly to cover, we have all our drivers here as well. So all the endogenous drivers that we're going to be looking at as we go through the endogenous analysis. And in the NMI sheet, you'll see that we've got the date, we have the NMI level, and we have the monthly change in the non-manufacturing index, and the data goes back to Jan 08. And if we scroll all the way down, we can see that the last piece of data came to us in this spreadsheet in February 2015. The level was 56.9 and the change was 0.2 of a point positive. Now, if you want to continue adding data into the ISM and the non-manufacturing spreadsheet, all you have to do is just add the next line, and you change the dates and data on the charts by going to select data, and series 1 is in this instance the NMI, and you literally just change the data to 88. And if you want to change the date, you go into the NMI and we scroll down, and we can see that it's capturing up to here, and we change the row to 88. So in that instance, we change the date and the data. If we want to change the date here, we go up to here, we do Control, Shift and down. That takes us to 87. We change to row 88. And that would capture any new data that we enter into row 88. So let's go back to the presentation for a moment and just discover what the non-manufacturing index is all about. So as we've already covered, the non-manufacturing index is all about the services sector. The report, the preliminary report, comes out at the beginning of each month. So there's 2 reports each month, a preliminary report that comes out at the beginning of the month, and a final report which is published towards the end of the month. And if you just go into the sources area again, you'll get the link. But why is it important? Well, the NMI is important because the service sector does make up 80% of the US economy. There are a couple of drawbacks. The data does only go back to 2008, so it's covering much less data and business cycles than the ISM. So we can't have as higher levels of confidence in the NMI as the ISM does. But it's also because it's the service sector, and the service sector includes contracts between parties and not real goods bought and sold. So there is a question mark over it in terms of its authenticity, in terms of analyzing real demand in the economy. So real goods bought and sold, because they're physical, they represent the purchase and sale of real goods. So there's small differences in the makeup and composition of the NMI versus the ISM. But as traders, portfolio managers, we do treat them pretty much in exactly the same way. And we're using them really to get a proxy for obtaining our views on GDP direction. And when it comes to currencies, we're looking at predicting inflationary or deflationary conditions and how central banks, governments will react, authorities will react to these situations. So we're looking for our view on the US economy and our currency view on the US dollar. And if we want to get a pictorial representation of what the NMI looks like, we can have a look at the data going back to 2008 and look at this relative to GDP growth. And you can see here it's actually quite similar to the ISM in that if we look at the last business cycle, we can see the NMI negative at the beginning of 2008. It does go positive for a while, but the warning signs were there. And then in end of 2008, we start to see real negative annualized GDP growth on a quarterly basis. We get trough conditions here. And 12, 18 months later, again, we get trough conditions in real GDP. And we can see here the current business cycle where the NMI is above 50 and growing, and it's grown at a pretty constant rate, and so has GDP, although there's been peaks in the data, but we've generally remained above 50, and we've been around this 55, 56 level on average since we've come out of the financial crisis. Now what we can do is go over to the spreadsheet. We've built this in exactly the same way as we've built the ISM, but the data is just going back to 2008, Jan 2008. So familiarize yourself with the data, make sure you go through it. The NMI is slightly different to the ISM in terms of its makeup. There's 4 areas that we look at: business activity, new orders, deliveries, inventories. There's a 25% weighting given to each area, and that creates the composite PMI for the non-manufacturing index, and that's what we're really interested in. How do we look at this? We actually score it in exactly the same way as we did before with the ISM. So the ISM and the NMI, we're scoring exactly the same way. Why is it important? Well, it's very leading in terms of the economy. So although the data only goes back to 2008, it's a very leading indicator, and it does give an 85% accuracy in terms of 12-month time lag in leading the economy. This is why we look at it in exactly the same way as the ISM, because US GDP is predicted by it with the 85% accuracy, even though the data only goes back to 2008. And US GDP overall drives global GDP growth. So we're using the NMI as an overall guide to a longer term or absolute fundamental currency direction. But we also use it as a head check by comparing the service sector to the manufacturing sector. So we're looking at both of them really in tandem. Again, the NMI also tells us what to expect from policymakers in Washington and at the Fed. So again, we're using prediction, so ISM non-manufacturing, we're using prediction indicators, leading indicators to predict coincident, so what's happening in the economy right now with inflation, jobs, GDP, and we're looking at predicting what the reaction is going to be from the Federal Reserve, the central bank, and Washington. And now what we're going to do, because we look at the ISM and NMI together, is we're going to go over to the spreadsheet and we're going to look at exactly how we attach scores to these situations in our two surveys, the ISM and the NMI. So let's go over to the spreadsheet and we're in the NMI tab here, and you can see we've got our NMI data going back to 2008, and if we scroll down to the bottom we got our latest data. So we get February 2015, which is reported in March, and we've got a score of 56.9. So that number is obviously growing, it's above 50, and if we look here we can see that it's also growing and at a slightly faster rate. Now when we look at the overall situation, we have to ask ourselves, how much is this growing compared to historical data? Because we are attaching a score here, and we can see that 56.9, so let's call it 57, is pretty high, and that is basically equivalent historically to pretty high levels of GDP growth. So GDP growth levels of around 3-4%, which is very high. If we go over to the ISM, we can see here that if we scroll right down to the bottom, we can see that the latest data, Feb 2015, which is reported in March, we can see that the score is 52.9, and it's growing because it's above 50, but it's slower. And you can actually see, if we look at the trend here, looking back, we can see that only 4 or 5 months ago, the ISM was at a level of around 57, 58, and it's been slowing down ever since. And what we have to do is look at the overall level of the ISM and look at this historically, and we can see that this level is actually pretty low historically, but it's still growing. Now if we go back to the presentation here and we look at our analysis that covers both surveys, for the NMI we've got a situation where the number is pretty high historically, and that's obviously growing at a rate above 50 and pretty high and growing faster. So we're going to have to score this quite highly. So we're looking here in the +5 to +8 range. But for the ISM, we've got a situation where it's been slowing down for quite a while, and it's quite a low rate historically, but it's above 50. So around 51, 52. So we need to be scoring this around here, and taken together we end up with a situation in our scorecard where if we go into here, we'll be putting the scores into our table. Now we're going to come onto these much later in the video series, but for now basically just accept that we're going to go through the whole process and then we're going to look at all the scores at the end. And the sources table is very similar to the US EndoScore table, except we have a few extra columns in here that we're going to be showing you later, which basically has all of the scores for everything in them. And what you can do is change these over time yourself. So let's go back to the presentation. So just a quick rundown before we continue to build out our endogenous process. What we've done here is we've looked at two very important surveys in the United States with the intention of predicting what's going to happen in the US economy in 12 to 18 months' time. And the reason why we're doing that is because we want to predict whether in 12 to 18 months' time there's going to be inflationary or deflationary conditions. And if we predict that now with this information, then it means that in 12 to 18 months' time, that our coincident indicators, so our inflation, prices in the economy, employment, and real GDP growth, those coincident indicators are either going to be in growth or inflationary conditions or contractionary, deflationary conditions. And if we can predict that, what we're predicting is essentially what the central bank will do with monetary policy and potentially the government with fiscal policy. So when you think back to our overall idea generation process, this is how it all works. Basically, what we're trying to do here is we're starting to look at drivers in an endogenous manner, drivers that tell us what will likely occur in the future. And here we're looking at our first set, which is surveys. And the reason we're doing that is because we want to predict what central banks and governments will do in the future and what coincident indicators will do in the future, so we can take a position in the currency now. Now, we haven't said what currency we're going to be taking a position against, so what's going to be on the other side. What we're saying is that we're going to qualitatively score what the outlook for the economy is in absolute terms, in an endogenous manner. So just try to understand the principles that we're using here, try to grasp the thought processes and the principles, and try to understand the numbers in the spreadsheet. If you need to do more work outside of the course on the ISM and the NMI, that's totally fine. No one said this was going to be easy. No one said this was going to be an overnight situation where you learn everything very, very quickly. Macroeconomics, the lessons you'll learn are very in-depth, and the subject is very in-depth as well. And if you need to do more work, I definitely advise doing it, because if you're going to be a profitable, consistently profitable currency trader, you really need to get your hands dirty in learning macroeconomics, because as we keep going back to in the video series, we've stated many times over that learning how to trade currencies properly is actually a big lesson in macroeconomics and international trade. What we're looking at here now is macroeconomics in an absolute static principle basis. So we're looking at it from an endogenous perspective. Later, when we look at it in relative terms, we're obviously going to be looking at relative drivers, and one of those drivers is international trade. So it's all about macroeconomics and all about international trade and about putting it all together. Now let's move on to our next survey, which is the University of Michigan Consumer Sentiment Index. So the University of Michigan Consumer Sentiment Index is all about the consumer. Earlier, we were looking at the other entity in the private sector, which is businesses. If you recall, there's only two entities that make up the private sector. It's businesses and consumers. So we have to look at both. We have to look at business sentiment and we have to look at consumer sentiment and look at the signals that they're giving us about predicting what's going to happen in the future. So the University of Michigan Consumer Sentiment Index is a consumer sentiment index for the United States, and it's the most popular one in the world. It gives you basically the confidence that consumers have about the stability and future prospects of their incomes. So what this does is basically give you an understanding of the overall trend to expect in the economy. So for example, if consumer sentiment is low, it basically means that consumers are likely to spend less money and save more and cause the economy to shrink. So if it's high, consumers will actually go out and spend more, save less, and cause the economy to expand. Because if they're feeling confident about the future prospects of the economy, they're expecting to be earning or making more money in the future. Therefore, they don't mind spending money now, they'll spend more. And if their sentiment is low, it means they don't have any confidence in the future and they're spending less, tightening their belts and putting money away for an expected rainy day. So they're predicting the economy to shrink and they spend less now. They're predicting the economy to expand, they spend more now. And consumer spending is important because it makes up 2/3 of US GDP. And the remainder is business and government spending. So we've got businesses in the private sector. Remember, businesses and consumers make up the private sector. And we've got government spending, which is the public sector. The Michigan data can be found at the link shown here in the presentation. We're going to go over to the spreadsheet in a second, but you can basically cut and paste the URL from the spreadsheet into your browser and you'll find it. University of Michigan releases a preliminary report on the second Friday of each month and the final survey on the fourth Friday of each month at 10 a.m. Eastern Time. Now, if we look at the University of Michigan Consumer Sentiment Index in a bit more detail, what we see is it's made up of two sub-indexes. It's made up of the Expectations Index and the Current Conditions Index. And the way this works is the Michigan Consumer Research Center conducts a telephone survey asking 500 consumers a series of questions on their personal finances and their opinions on future business conditions. And you might think this is a small sample size, but it's actually incredibly accurate historically. The Expectations Index is the questions that they get asked on their expectations of future business conditions, and the current conditions, they get asked about what their thoughts are on the current business conditions and current personal finances. And basically the way to look at the UMCSI is a bit different to the ISM and non-manufacturing index because it doesn't actually have defined levels that signify expansion and contraction in the US economy. So if you recall, when we looked at the ISM and the NMI, we looked at the level above 50 to indicate growth and a level below 50 to indicate contraction. But the UMCSI doesn't have this predefined level of 50 or any predefined level at all. What you actually have to do is correlate the level of the UMCSI historically with the levels of GDP growth that they predict. So long term, the average level of the consumer sentiment index is 85, and this coincides with approximately a long-term growth rate in the United States of around 3%. So we can deduce the following really. If the readings of the University of Michigan Consumer Sentiment Index are above 80, then it means we've got bullish consumers. We can expect a higher than 2% GDP growth. Readings kind of between 70 and 80 are benign consumers. So they're neither bullish or bearish. and we can expect a growth rate of between 0 to 2%. Readings between 55 and 70 are very bearish US consumers, and we can expect contractionary conditions in the future in real GDP growth, and we expect low growth rates of around 0 to -3%. So how does the UMCSI look when we look at it pictorially against GDP? Well, you can see from looking at this chart, which is available in the endogenous driver analysis spreadsheet, you can see that GDP growth really does follow and is highly correlated to the level of the UMCSI. Now, if we go over to the spreadsheet, we can see this in a bit more detail. So we're in the NMI tab at the moment. Let's go to the UMCSI. In the UMCSI tab, you can see that our data set goes back to 1978, and all we care about here is the absolute level of the UMCSI and the change month on month, not in percentage terms, but in a points analysis. So this is just the change that gets reported every month. And if we go into our sources tab, you'll be able to see that the source, the link, is in the table in the cell next to consumer sentiment, and we can just click on that, and that takes us to the University of Michigan Consumer Survey website, and we can go into our data archive here to download everything. So if you want to get the data yourself, just go to the website, download it, but all the data's here for you. And all you have to do to update this spreadsheet is, again, scroll down to the bottom and just put in the latest number here. The latest number we have here is for March 2015, so that's reported in April. So feel free to update these sheets if you want to. And if we scroll down, we can look at this chart more closely. What are we looking at? Well, we've got the absolute level of the UMCSI here, and we've got the level of real GDP growth on the right-hand side here. And what we're looking for is consistency in our data, in that we're looking for levels of the UMCSI that are consistent with levels of real GDP growth. And the average level of the UMCSI is 85. You can check that if you run through the data by just bringing up a trend line of the average of the entire data onto your chart. And this is consistent with levels of around 3% GDP growth. Now, where's the GDP data coming from? If we go onto the chart and select the data, reference the GDP data here, and if we just click into edit and highlight it, you'll see that it's coming from the tab GDP, which is all the way on the right hand side of our spreadsheet file. And if we just OK that, we're going to end up back into the UMCSI sheet here. And we know how to draw these charts. Basically, we're just referencing this data. We're going insert, and we're choosing our 2D chart and turning it into a line, and then adding our GDP data onto it. Now, when it comes to the scorecard, we have to take a slightly different approach with the UMCSI relative to the ISM and the NMI, because as mentioned previously, if we just widen this a little bit, as we mentioned previously, there is no defined growth and contractionary level with the UMCSI. So what we have to do is look at the data and match up historically the level of GDP growth that's consistent with a certain level of the UMCSI. And the way we do that is pretty straightforward. If we start here in column AY, we look here at the average level of the UMCSI historically, which is 85. And that level of the UMCSI, 85, the average of the historical data, is consistent with levels of 3% GDP growth. And as GDP growth is predicted lower, obviously the UMCSI is predicted lower. And we end up with situations like column AJ, where if the UMCSI is at 70, historically, this is consistent with no growth in the US economy. So GDP, real GDP growth of 0. And we go all the way down the scale to the lowest levels of the UMCSI recorded. And this is consistent down here. A 55 reading in the UMCSI is consistent with minus 3% GDP growth. And if we go further to the right, so we go above the average, this is obviously higher readings of the UMCSI. They are consistent with much higher levels of GDP growth above the average. Now, when we look at our scorecard, which is our next row here, you can see essentially there's 5 zones that we need to look at, and we've also color coded these zones as well. Now, if we go back to the presentation, we have a full explanation of how the scorecard is scored. And from our analysis earlier, we discovered that multiple readings above 80, we get very bullish consumers. So we expect a higher than 2% GDP growth rate. Readings between 70 and 80, we're expecting benign consumers because we get GDP growth rates in the future of 0 to 2%. And if we get readings between 55 and 70, historically, this is consistent with low GDP growth, so contractionary levels of 0 to minus 3%, and we get very bearish consumers. And in our zones here, we'll explain these in a second, we get different biases because we're predicting inflationary and deflationary conditions consistent with different levels of the UMCSI. Now, if there's extreme bullish and bearish sentiment, this can mean that we've got peaked, so overly bullish conditions, and troughed, overly bearish conditions. So sentiment from consumers being overly bullish or overly bearish. And this is a good example of how you've got to think differently in the extremes. So similar to the way the ISM and the NMI works. Policymakers in the future, when they see this, they're more likely to take the opposite action to what they're seeing in the extreme circumstances. So for example, if we get multiple readings of the UMCSI up here, what's likely to happen is that central authorities like the Fed, the central bank, are going to look at this and they're going to come to the conclusion that the economy is potentially overheating. And this is extremely bullish sentiment. So what we could, in fact, be predicting here is that in the future, we're going to get deflation because it can't get any better. It's peaked. And then in the opposite situation, we have a sluggish economy where we do actually have really bad conditions, but the case is extreme. And it's more than likely that the Fed in the future is going to try to create inflation to erase this situation. So in the extreme scenario on this side, we have extreme bearish sentiment during a sluggish economy. and we're predicting that in the future we're going to get inflation because the central authorities are going to act. So there's various ways in which they can act. They can use interest rates and money supply, and they can be increased in order to create deflation. So interest rates increase and money supply decreases. Or they could do the opposite to create inflation, which is to decrease interest rates and increase money supply. So in the extreme cases, this is what we have. We have a situation where we're predicting that in the future, policymakers are actually going to react to this situation, and we're predicting deflation. So in the extreme case of very high readings in the UMCSI, we will look to have a long bias. In the extreme cases where we've got extreme bearishness from consumers, we're looking to predict inflation because it can't get any worse, and we're looking for a short bias in predicting inflation, a short bias to the currency, and over here a long bias to the currency. So I hope all these principles are starting to sink in. Now obviously it's a little bit difficult to grasp these principles immediately, but just stick with it. It should all start to come together. If we look at how we scorecard here, how we break everything down, we've talked about the bearish and the bullish situations at the extremes. So at the bullish extreme, we're looking to have a long currency bias because we're expecting a tightening policy from the central bank, the Fed. And in the bearish extreme, we're looking to have a short currency bias because we expect a loosening monetary policy from the central bank, and we're predicting inflation. So what about when we look in the range that's within the extremes? So we're looking at the range from 63 up to 95. Well, let's start with the first section, which is when the UMCSI is predicting a slowdown. So we go from this section here, 63 to 73. So we're looking at levels of GDP that are extremely low and almost zero. And the way we score that situation is that it's pretty deflationary, because once we start dropping below 1% GDP growth in the United States, we've got basically deflationary conditions. The economy is under threat, and we could actually be going into a contractionary situation. So the way we score things here is that we use a sliding scale from 0 down to -10, and we have a long bias because we're scoring for deflation. We have a minus number on a sliding scale, and you'll notice that what happens is we're getting longer and longer the currency in terms of conviction, because deflation is becoming more and more. But the principle here is that when it becomes extreme, we have to be prepared to flip in our analysis. What does that mean? It means that we get to a certain point where deflation is at a level where the authorities are not responding, but we know from history that when we get into this zone here on the UMCSI, this is predicting levels of GDP growth where it's extreme, and the central authorities have to act. They have to create inflation. So we have to be prepared to flip in our bias from being from predicting deflation and having a long bias to predicting inflation, because we're getting to extreme levels. So we tend to have a long currency bias when we start dropping below 73 around the 74 level on the UMCSI, because this is going to predict very slow GDP growth and even negative GDP growth. But when we get to the extremes, we have to be prepared to flip, because this is when central authorities are forced into doing things because they have to keep the economy going. So what about the opposite situation? So when we are predicting growth, so when we're looking at this level here from 76 up to 95, well, the same principle applies. We kind of have normal conditions here, so we're scoring on a sliding scale, but the increments are in 0.2 in GDP growth, and we have a normal situation here where growth in the economy is between 1 and 3%, and we score much lower on conviction here than when we score on our sliding scale here in absolute terms, because these are normal conditions. And the extreme condition is when we get up here. And as we get more and more extreme beyond the average, we get more and more higher scores for inflationary conditions, where we have to have quite an extreme short bias in the currency. But then similar to the left-hand side, when things get extreme, we have to be prepared to flip, because history tells us that when we get into this zone here, where the UMCSI is reporting above 95, and we're predicting extreme levels of GDP growth, the central authorities will act to cool down the economy. So we have to understand these principles, that when we scorecard, we have to predict inflation and deflation, but we also have to predict from our data that historically central authorities will act if they have to on the extremes. So we tend to have 4 zones where we have a long bias in a deflationary condition, a short bias in an inflationary condition, but when we have extreme deflationary conditions predicted, we have a short bias because we're actually predicting inflation. And when we have extreme inflationary conditions predicted, we actually start predicting deflation because it can't get any better. And central authorities will have to intervene because they don't want it to get any worse. And they will have to intervene because inflation may get out of control away from the target rate. So we have to bear in mind these extremes, and we have to operate within the parameters. So let's break this down a little bit further for you. Let's try to think of this in a pretty straightforward manner. The closer we get to the extreme bearishness, so consumers getting really bearish, the higher the likelihood that the central authorities will react, and react with a loosening monetary policy. The closer we get to extreme bullishness on behalf of consumers, the higher the likelihood that the central authorities will act, and will act with a tightening monetary policy response. However, it's pretty obvious that consumers spend most of their time being mildly bullish or bearish and benign. And GDP spends most of its time growing at a normal or non-extreme pace. In that case, we have a bias either way for a long time during each cycle. And what we do is we just scorecard from a scale of -10 to +10 on inflationary and deflationary expectations. And as we've seen, we scorecard with a sliding scale. Now, the sliding scale is a best practices guide. It's a qualitative guide, and it's by no means a rules-based system. Rules do not exist when GDP growth, jobs, and inflation or deflation is a concern. At the end of the day, policymakers can, in the end, just do exactly what they want to do. And we can't really 100% predict what's going to happen. But we can try to go through a qualitative process and a systematic process to scorecard objectively what is occurring in the economy. And by doing that, as professional traders, we're going through a process that cuts out all the noise. And this is what we have to do as professional traders to ensure that we're being objective. So we go through the endogenous analysis and we qualitatively score everything objectively. And why this is such a good process is also because it's adaptable, and the inputs to the overall systematic process can be added to, they can be changed, and as time goes by and different economic conditions occur in major cycles, we can qualitatively tweak the model. And this is what professional trading and investing is all about. It's creating objective systematic processes that are adaptable to future economic conditions. So we don't have a rigid rules-based system. It can actually perform and mold over time.
Now we're going to move on to our next economic number as part of our surveys. We're going to move on to building permits, or the Census Bureau's monthly report on building permits. And this is a really good number for us. It's another leading indicator as part of our surveys data for predicting economic growth. Because what it's all about, it's about the US housing sector. And in general, the housing sector does provide us with multiple economic indicators that can help us make decisions on whether we believe the US economy will likely grow or not. And the Census Bureau's monthly report on building permits comes from the general US housing starts report. It's, again, a leading indicator that we use to predict GDP growth. And if you want to get the data, it's available in the spreadsheet, in the endogenous analysis spreadsheet under permits. And the link, if you follow this, you can get all the historical data from the original source at the Census Bureau. And the housing starts report, the data is released on the second or third week of each month. And the data is for the previous month. So we've got it all available in the downloads, but you can go to the original source and get it here from the link and in the sources section as well. Now, the building permits number is really useful because it's one of the most misunderstood economic numbers in the United States. Even professional traders and seasoned economists miss really important signals that the building permits data gives us each month.
And because this number is a quite widely misunderstood number, that's why it's so useful, because it does predict GDP in the future with a very high level of confidence. Because it's so misunderstood, it's one of those ones that's not widely looked at as much as the others. And this is how it's useful. There's basically three numbers within the monthly housing starts numbers, and each of them has a different definition in terms of the way economists would define the actual data. Let's start right at the end of the flow. So a housing completion. If we define that first, this will help you understand what this really means, I think, in a lot better explanation. A housing completion is basically the structure and the major interior work of a house that's been completed, and the home is actually currently being marketed for sale. So Housing completion in the housing starts report is a house that's done and is gone on the market. So all the structure and major interior work has been completed and the home has been put on the market. Now, before that, the home itself, before it's been fully built, is a housing start. And the housing start is defined as the foundations of the building. So the residential building, the foundations have actually been laid. So the project has actually started. And you can see that the flow works from left to right because obviously the housing completion, the complete house at some point must have been built. So the housing start is the data captured every month when there's an amount of homes in the United States where the foundations of the residential home have been laid and the project has started. And building permits right at the beginning, what this is the permit from the local state planning department giving planning permission to actually build the residential home. So you can see how the flow works. We start off as a property developer putting in a planning application at the local state planning department to build a home. We then start building the home, and that's why it's called a housing start, because we start by building the foundations after we've received the planning permission. And then later, once the house has been built, the house is then marketed for sale. And the way this works is that the building permit application is a leading indicator in itself. The housing start is a coincident indicator because it tells us what's happening in the economy at this moment in time. And the housing completion is a lagging indicator because it tells us that the house has now been built and is being marketed for sale, and the project is essentially finished. So you can see how the flow works. Building permits are considered a leading indicator because if there's a very high level of applications going in to all state planning departments across the United States, then it means that a lot of houses are going to be started to be built in the future, and a lot of houses will come on the market for sale in the future. And the reverse is true. If the building permit number is very, very low, so the amount of applications statewide that go into local state planning departments is really low, then it means that there's going to be less housing projects started, so less housing starts, and therefore further down the line, less completions. So what this number does for us is give us a very good indication of the growth in the future of the US housing market. And that in itself is an extremely important indicator to the future health of the US economy. And if we think about this in a bit more detail, the building permits number tells us a number of things. So the first thing it tells us is whether or not developers themselves are bullish or bearish on the prospects of future home sales. Because the more applications that are made in terms of permits going into local state planning departments, permit applications, it means that there's a higher expectation of future sales. It actually costs money to make a planning application. So it costs anything between $500 to $1,000 per home to make the application. And of course, these guys don't do it for fun. If it costs money, it's pretty serious. So it gives us a very good indication of whether developers are bullish or bearish or not. If there's a lot of applications going in, they're paying a lot of money for permits. If there's not a lot of applications going in, they're not paying any money for permits for future projects. So it's an indication of how bullish or bearish they are. The second thing it tells us is the demand for US housing from the US consumer, because it might eventually be a situation where we see changes in consumer sentiment and consumer spending. So for example, if building permits is very high, then it means that US consumers are actually looking at purchasing homes in the future. Otherwise, developers would not be making the applications, and this will drip down into consumer sentiment and consumer spending. The third thing it tells us, and this is what a lot of people don't realize, is that it gives us an idea of the supply of loans. So developers in the US don't finance projects with 100% equity or cash. What they do is obviously they use a mix of equity, cash, and debt. And also consumers in the US don't buy houses for cash, they buy them with debt. So they buy them with mortgages. So basically it gives you a litmus test almost. It gives you a barometer as to the health of the US economy and also the health and liquidity of the US debt market. So this gives us an idea of whether the monetary base is set to expand, i.e. inflationary, or contract, so deflationary conditions. Now we can go over to the spreadsheet, endogenous driver analysis, and we can take a closer look at building permits when we're looking at GDP and building permits in terms of gauging inflation or deflation. So if we go out of the presentation here and we head over to the spreadsheet, you want to make sure that you're in the Permits SA tab, and we have our data, our charts, and our scorecard. Now what you can do is go over to the Sources tab, and you can see we've got the link here as well. And if you click on that, the website of the United States Census Bureau comes up, and you can download all the files here or PDFs here for the housing starts data, and you'll find the building permits data is part of the housing starts report. So let's go back to the Excel spreadsheet and have a look at how we work all of this out. And we go into the Permits Seasonally Adjusted tab. And you can see here we've created an absolute chart for building permits. And we've got the chart that was in the presentation earlier, where we're comparing to GDP. And we treat it like our other leading indicators. What we're trying to do here is perform a qualitative analysis where we're trying to match up historically levels of building permits with corresponding levels of GDP. And if we go to our scorecard over here, you'll see that we have a very similar analysis to the UMCSI earlier. And if we go back into the presentation, we've got a better explanation here. And the way things work in building permits is very similar to UMCSI. We have four main areas. And you can see we have our extreme areas here. And extremely low levels of permits historically have meant a really extremely tight lending environment and deflationary conditions. And the extreme situation, similar to the UMCSI, means that in terms of our predictions for the future, we're predicting that we'll get looser monetary policy. So perhaps looser interest rates, lower interest rates, and increased money supply. And what we do on the extremes is we're predicting inflation. So we give it a positive score and we get a short currency bias. At extremely high levels of permits, historically that's meant an extremely loose lending environment. And what we do is we predict at the extreme that we're going to be getting tighter monetary policy, so higher interest rates and decreased money supply. So we're predicting deflation. We give it quite an extreme negative score, and we get a long currency bias. So when we look at the section in between, when permits are below 1 million, so we're looking around this level here, when permits are below 1 million, we're predicting or indicating a slowdown in future levels of GDP growth, and we tend towards a long currency bias. And the slowdown, historically, slowdowns are usually an occurrence of tight monetary policy. And if it gets too extreme, the future policy is to loosen on the extreme, as we've already looked at. Now, when permits are above 1 million, we're predicting or indicating an increase in levels of future GDP growth above 0. And we tend to have a short currency bias because higher growth is usually an occurrence of looser monetary policy. And on the extremes, future policy is to tighten, as we've already seen. So you can see how the scorecard of building permits actually looks. The composition of it is pretty similar to the UMCSI. So we can now look at them both and have a look at what scores we're very likely to give them. So if we go over to the spreadsheet, and we're in the permits seasonally adjusted sheet here, and you can see we've got all the data on the left hand side. And if we scroll down to the latest data, we just remind ourselves that we've got a monthly seasonally adjusted annualized rate in building permit applications of 1,053,000 applications. And all we have to do is look in our table, our qualitative table, to see what levels of GDP growth this is consistent with and what score we can give it. Well, it's going to be around here. So between 1 million and 1.1, and we're going to have a score of between 0 and -3. Now, if we go into the UMCSI, we can have a look at the way we get the score here. The UMCSI is coming in at 91.2 for March, and the figure is -4.2 in terms of change month on month. So it's a very high number, but it's actually falling quite a lot. So how do we scorecard this? Well, we look for 91, and we can see this is consistent with very high levels of GDP growth. And it's almost a very extremely inflationary rate. But we're going to scorecard this very highly at probably around a score of 8. So you can see how we scorecard these things in quite a similar way. The building permits number is giving an indication of very low levels of growth, potential deflation, but US consumers are disagreeing. US consumers are basically saying that they're very bullish. So we have very high inflationary conditions here, and we have tentative conditions here. So very low growth, so 0 to 1% GDP growth indicated by the building permits number, and potential deflationary conditions. So these things, basically, when you create a big scorecard, which we'll look at later, they do net each other out, and we get a general broad average of what the future outlook is for the US economy and the US dollar in an endogenous format. Remember, that's key. So let's go back over to the presentation, and let's just summarize the building permits number. Okay, so we've seen that building permits are a pretty useful leading indicator and leading driver of future GDP growth and potentially employment and inflation. And it's part of our endogenous analysis as a leading driver and within our surveys analysis. And it's useful in a number of ways because it's telling us the future levels of activity in the housing sector. And the housing sector is obviously a big driver of overall GDP growth, employment and inflation in the United States. And it's vitally important to our outlook for GDP growth and inflation and even jobs. So the building permits number as a leading indicator, you have to remind yourself and understand how this works. Completions follow housing starts, and housing starts follow permits. So housing starts are the coincident indicator, and completions are the lagging indicator. However, the building permits number doesn't just tell us the future of GDP growth. It also tells us whether developers are bullish or bearish on the prospects of the housing sector. And it also gives us an idea of the combination of developer financing and whether they're forecasting a demand for housing in the future. But it also tells us as well whether consumers are demanding housing. So if they demand housing, then it probably means that the ability for them to get a mortgage is higher. Therefore, the loan environment is better. It gives you a good barometer of the health of the US debt market, so the liquidity in the banking sector. And that in itself is very important for the overall economy. So taken all together, this means that basically the building permits number is giving you an insight into the health of money itself. So if you remember, we talked about the money supply and the fractional reserve banking system, the reserve ratio requirement, and new loans in the banking sector. What that is doing is basically giving you an indication of the liquidity of the banking sector and the potential for a change in consumer spending habits, and therefore the inflation outlook. So the inflation of prices in the economy. So what it's doing is building permits is giving us a very, very good gauge on the outlook for inflationary or deflationary conditions. And one final thing that I want to touch on with building permits is something that you should be thinking about across all economic indicators, as in whether it's a leading, coincident, or lagging indicator, and what your inputs are in terms of importance that you place on them. Because it's very easy as a retail trader to sit and look at the economic calendar of economic releases coming out and placing high importance on indicators that actually lag the economy, and using these indicators as inputs for your decision-making process in terms of taking positions in currencies. And there's so many problems with doing that. It's just a strategy that's completely fraught with danger. And what you're going to get is retail brokers all the time pumping you with information that these numbers actually really matter. Now, if you look at the building permits number, there's many US housing market numbers that come out during the month. We've got the housing starts number, which the building permits number is part of, the completions number, which is part of the housing starts overall report. We've got pending home sales, new home sales, existing home sales, the Case-Shiller index, and the housing market index. And all of these indicators are actually lagging indicators. They lag numbers like the building permits number. So they're either coincident or lagging, very lagging numbers. So they either tell us what's happening right now in the economy, or they tell us what's happened in the past. The leading indicators tell us what's happened in the future. What you need to be really careful of is getting into this awful habit of buying or selling a currency pair because a lagging indicator came out and the number was either better or worse than expected. The point is simple. Professional traders are looking at leading indicators and predicting what happens in the future. Therefore, if you do this across the board, where you're looking at lagging indicators, professional traders have basically predicted what the lagging indicators are going to be 6 to 12 months previously. And currencies, the stock market, commodities prices, and bond prices are leading indicators in themselves, because the professionals are looking at leading indicator survey data and almost immediately taking positions in currencies, commodities, bonds or interest rates, products, and the stock market, almost immediately taking positions in those assets and using those assets as a barometer to make profit out of the future moves. So what happens is these things get discounted in very quickly. And if you're the retail trader who waits for 6 months for the lagging number to come out, basically what you're doing is you're reacting to a move that's already occurred. And let's say, for example, a bullish leading indicator number came out in month 1, and then from month 1 to month 12, we saw growth in GDP. Well, if you're the person that looks at the lagging indicator, which is GDP itself, or one of these other lagging indicators like new home sales, or the Case-Shiller index, or the housing market index, you then are the person who buys when that number is good in month number 12. But the move's already occurred, and asset prices have already discounted that in their price that it's going to occur months in advance. In fact, in month 12, the same guys are looking at 12 months ahead, the same professional traders. And if the leading indicators are poor, what you're going to do is end up buying on the lagging indicator, and the professional traders are going to end up selling to you on the leading indicator. And you're going to be the person who's left holding the baby. So you can see now how the dumb money react to things and the smart money predict things. This is it. This is the whole systematic process coming together. So we've covered surveys now. Let's go over to the trading desk for a full recap and rundown of surveys.
Okay, so welcome back to the trading desk. There was obviously a lot of information in that particular video. So let's try and go through everything in a very succinct manner to try and get this to stick in terms of your understanding. So the first thing we did in the video there was we started to outline the systematic process and how this professional systematic approach actually works and how it actually gets built out. The first thing we looked at was how a systematic process relates across all asset classes, and we quickly looked at the systematic process that applies to the PTM video series, and subscribers to the PTM have seen that already and understand how that systematic process can branch out across all other asset classes. And then what we did was we then looked at how currencies link to this overall process. And we then zoomed in to currencies to see the moving parts within currencies and how we actually get fundamental trade ideas in currencies and how we actually end up with positions and what we do with those positions once we've got them. And the systematic process within currencies that we zoomed into is extremely similar to the way we do things in all asset classes. The systematic process is just basically a tweaked version and applied to currencies and the nuances of currencies relative to other asset classes, and the same applies in other asset classes as well. Each systematic process is basically a tweaked version of an overall process. And we then, in the next section, we basically zoomed in onto the particular part of the overall process, which was the fundamental idea generation process. And we started to look at how we break down the currency market in order to generate fundamental ideas. And the first thing we did was break up drivers into endogenous and exogenous drivers. And we started to look at endogenous drivers and started to look at generating scorecards. So this idea of scorecarding everything on a scale that allows us to gauge inflationary and deflationary conditions from those drivers. So the first endogenous driver that we looked at was surveys, and we looked at the ISM, the NMI, the UMCSI, and also building permits. And these are the big major leading indicators in the United States. Now, the reason why we look at these first within the endogenous analysis is that we're trying to gauge and predict inflationary or deflationary conditions in the future. Because we know that if we have a high level of certainty of inflationary and deflationary conditions in the future now, we know basically how authorities, so central banks and governments, will react, because they are primarily concerned with the coincident drivers or coincident indicators. They are primarily concerned with them because they are affected or policy committed to making them change or keeping them at certain levels. So the drivers, the leading drivers, are extremely important in our analysis, and they come first because they're leading. They help us predict what authorities will do, because authorities are looking at these drivers themselves, because they are committed to affecting the coincident indicators. So just to cover the whole process, again, it's essentially building out the systematic process so you understand how professionals drill from the top down, how they build out processes that enable them to generate high quality trade ideas and real life positions in the market that have a very high confidence level. And starting right from the top, we start building out the systematic process with fundamental drivers. So we split up everything into endogenous and exogenous, and endogenous is looking at a country in absolute terms, so not comparing the country to anything yet. And exogenous is comparing the country to another country, and those drivers that affect the two countries together. So when we look at endogenous, we're basically only looking at the drivers that really affect the country internally, domestically, and how policymakers will probably react to that. So we then build out and we look at the first driver, which is surveys, and we have multiple drivers coming throughout the video series that we're going to look at. So if you need to go back and have a look and understand how the overall process really works, it's really worth just watching it over a few times and just getting it and understanding it. Because if you keep this in the back of your mind, when you're getting into the nitty-gritty detail of the drivers themselves and how they're affecting our potential currency decisions through predicting inflationary and deflationary drivers, if you keep this in the back of your mind, you'll have a bigger picture understanding and appreciation of where everything is coming from. So it's pretty important. Try to get it and understand it. And with surveys, we saw as leading indicators that they have a very high level of confidence. They are fantastic indicators, and you should be watching them every single month and updating your spreadsheets from the download section and really getting into the detail of those spreadsheets and understanding how they work. So try to reverse engineer the examples and figure out each month what each number means and scorecarding them so you can actually build an idea of what's going to happen in the future. This will give you a very strong indication on future inflationary and deflationary conditions, and therefore potential central bank, government, central authority reaction, and therefore will give you default or original ideas in terms of your view on the US dollar. For subscribers of the PTM video series, a view on the US dollar really connects to your worldview. So I know this can get a little bit complex, but stick with it, try to understand it. It's not as complicated as you think. If you just go into the spreadsheets, work the numbers, try to figure out how it all works, the numbers will start to speak for themselves, and try to understand the overall process and keep it in the back of your mind. Again, we can't go through a process here where we spoon feed you all the numbers. The best thing we can do is, in terms of teaching you, is teach you a way, a process that you can take away and apply for yourself. It's the best way to teach, because you will be learning by doing and learning through immersion, and therefore learning quicker and getting your own results over and over again. It's the best way to do it. So let's go over to video number 8 now, and I'll see you on the other side.